Quenpielo here to discuss Chapter 5 topics related to accounting for merchandising operations. To date, our examples assume the business owner was only providing services as their sales revenue. In this chapter, we'll move to the buying and selling of goods. Introducing a merchandising business like Walmart or Target brings a new asset into play which must be accounted for. The items retailers purchase for resale to consumers. We call this inventory, sometimes referred to as merchandise inventory. This one addition to our accounting, dealing with inventory for resale, adds a lot to our accounting duties. There are several new other accounts to deal with as well, because the buying and selling of goods gives rise to many business practices, such as buying and selling on credit, which may involve giving discounts if the items are sold quickly, or they're paid for quickly, or sales returns for merchandise returned to the seller. As you can readily imagine, the nature of accounting for all these possibilities greatly increases the transactions that are tracked through the accounts. We'll be looking at business transactions from both a buyer and seller perspective, so it's important to keep track of which cycle is occurring. Looking at both perspectives adds complexity to this chapter. We'll also comment on two different formats that an income statement can use. Both are acceptable in practice, even though one dominates in usage. The dominant form uses a new term and subtotal called gross profit, which is not the same thing as bottom line net income. This chapter introduces several new topics as well as new accounts that merchandisers, otherwise known as retailers, use in their daily operations. In this chapter, as in others that follow, it's important to immediately classify any new account introduced, which part of the equation does it belong to, and which function of the business uses it. As mentioned, the first new account to deal with is inventory. Immediately, a business needs to decide how frequently this asset account is updated. This refers to either the perpetual or periodic method of accounting for inventory. We'll be focusing on the perpetual method, which means we will be continually updating the inventory account value after each purchase and each sale transaction, and anything else that may affect its value. In terms of recording purchases of merchandise, this refers to the buying side, and use of the perpetual method of accounting for inventory means this account will be very actively used. The recording of sales is self-explanatory at retail selling prices. This selling function will also bring new accounts we have to deal with that involve modifications to our basic sales account when dealing with customer actions. We will not be focusing on adjusting or closing entries since prior chapters covered this, only looking at some summary effects. In terms of the income statement, the new accounts introduced in this chapter leads us to look at a modified income statement format with new subtotals. A multiple step income statement simply means that there are multiple subtractions of different types of operating costs before arriving at net income. The multiple step income statement is much more informative, although the single step income statement is also acceptable in practice. A word of caution. This chapter has several challenges because of the new concepts introduced. This very simple thing of inventory, items purchased for resale to customers, does introduce a level of complexity which must be dealt with. When inventory is sold, we logically have to remove it from our books and classify this expense under our owner's equity area as a cost of goods sold. This cost is so major that it actually changes the form of our income statement. And as indicated, introduces a new term called gross profit. This is simply a profit subtotal, sales less cost of goods sold equals gross profit. This is part of the multiple step income statement that we'll look at shortly. There are several other business practices that we'll be looking at. When merchandise is sold on credit, there can be several items that affects the seller. Items can be returned by buyers back to the seller. Cash discounts can be given to a buyer if prompt payment is made. And so we have new accounts that the seller has to deal with, such as sales returns or sales discounts. So this is a very important chapter, and I encourage you to really strive for an understanding of its contents. And on top of this new account, as indicated before, we have two different methods we can account for it. Now we'll be only focusing on one of these methods, called the perpetual method versus the periodic method. There is additional work in terms of journal entries on the perpetual method. However, it does give much more information to the retailer, and it is the method of choice. Just a reminder, as you go through this chapter, keep the activities of buying and selling separate in your mind. They have different accounting implications. Okay, let's talk about the fundamentals of merchandising companies. In the middle of the screen here, example of Office Depot is a retailer will buy from wholesalers and make those goods available for sale to consumers. So the retailer is in a purchasing mode before it's in a selling mode. Here's how a merchandiser measures income during a period of time. The sales revenue start is obvious. It's the amount that goods are sold to customers, the retail price. Subtracted from that is an item called cost of goods sold. This is the amount of purchases of inventory made during a period that are sold during that period to customers. Inventory is not an item that a service business has to deal with, only a merchandiser. And so therefore, the cost of goods sold classification would not be part of a service business, but shows up in a merchandising income statement. The structure we're looking at right here effectively is a multiple step income statement. So the retail price sold to customers less the cost of merchandise purchased and sold equals this new subtotal called gross profit. From that, there are other operating expenses the business must deduct: salaries, rent, depreciation, before arriving at bottom line net income. Let's compare what's called the operating cycle of a service company to an operating cycle of a merchandising company. The service company operating cycle, often referred to as the cash cycle, simply involves what step and how quick items are turned into cash once they're sold. As we can see at the top, a service company obtains sales by performing services. In this case here, auto repair. The service is done on account. Receivables are later collected and turned into cash. A merchandising operation at the bottom here must first buy inventory, items made for resale to customers. Keep track of that merchandise inventory. It's a very important part of this chapter. Then sell it. It's sold on credit. An account receivable is established and again turned into cash upon collection. Let me comment on two events once inventory is sold to a customer. First of all, the customer may return it and never pay the accounts receivable because they've returned the goods. Secondly, the merchandiser may want a prompt payment of that receivable and actually offer a cash discount for early payment. Both of these cases affect our accounting in this chapter. Glancing briefly at this new asset, this new merchandise inventory account, it's a current asset because it's intended to be sold and turned into cash. If a credit sale, it'll go through receivables first, but then collected in cash. This one new asset on the balance sheet brings into play many accounting entries for merchandisers. So in this chapter, we need to be aware of the flow of costs into and out of this inventory account. Merchandisers will commonly always carry a balance in inventory. During a period of time, they'll purchase new goods. The combination of that beginning inventory and cost of newly purchased items becomes a total cost of goods available for sale. simply the total amount of goods during a period of time that are available for sale to customers. And then at any point in time, daily, either the goods have been sold, in which case they're classified as a cost of goods sold, or they're still on hand, ending inventory at the end of that day or hour or whenever. As previously mentioned, the method of accounting for inventory, perpetual versus periodic, simply refers to how often the inventory account is updated. We'll be concentrating on the perpetual method of inventory system. We're going to update that inventory account all the time, after every purchase, after every sale. The perpetual system provides a lot more information to merchandisers than the periodic method. Showing a simple T-account diagram of this asset, merchandise inventory. Beginning balances, purchases will be added to them, and as items are sold on a perpetual basis, we'll move them out of inventory, resulting in an ending balance at the end of any point of time. A key learning in this chapter is items are sold and removed from merchandise inventory, that the journal entry is to credit merchandise inventory for the cost of items sold and debit an offsetting account called cost of goods sold, the latter of which becomes an expense deduction on the income statement. We'll see that the cost of goods sold expense item is the major expense item on any income statement. The perpetual system of inventory accounting is that which we'll be focusing on in this chapter. As indicated, it maintains detailed records of the cost of each item purchased and sold. The record is continuously updated as sales are made, as purchases are made. So at any point in time, we know what's on hand, and we also calculate the cost of goods sold each time a sale occurs. We don't wait till month end to make that calculation, but each time a sale occurs, we'll make an entry reducing inventory and charging the cost of goods sold account. This contrasts with the periodic system, which we do not keep detailed records of goods on hand. That means companies using the periodic method do not know their inventory value until month end when they actually count it, so only periodically. And furthermore, the cost of goods sold is not recorded after each sale. Under a periodic system, the cost of goods sold is determined only at month end, when the inventory value is also determined by inventory count, a physical inventory. Use of the perpetual system provides much better control of inventories. There's continuously updating as to its balance. But as indicated, this does require additional work and journal entries to maintain these records. But it does result in better control of the inventory account. After every purchase and every sale, the inventory account is updated, so the merchandiser knows exactly what's on hand available for sale. This continual updating of inventory gives the name perpetual method. So let's start on the buying side of merchandisers. And I want you to be very careful to watch the dominance of the inventory account in the series of purchasing entries. Furthermore, if the buyer is responsible for paying freight costs, the cost to move items from the supplier to the purchaser, the inventory account will also be increased. This is a concept known as landed cost. That is simply another cost of making inventory available for sale to customers. If the buyer of merchandise returns this before selling it, it's no longer available for sale, and so the buyer must reduce the inventory account each time this action occurs. Also, if the buyer buying on credit earns a prompt payment discount, when payment is made by the buyer to the seller, less cash is exchanged than the amount in accounts payable. In this case, In fact, the inventory is costing the buyer less, and the inventory count must be reduced for any prompt payment discounts earned by the buyer. A merchandiser can buy purchases of inventory using cash or credit. This chapter assumes that our purchases will all be made on credit. In other words, as we buy them and increase our inventory, we'll increase in accounts payable at the same time because we'll pay that off later. The illustration here shows us a purchase invoice, which is evidence that a purchase of merchandise has occurred. In this case, PW Audio is the supplier. The buyer is SAUK Stereo. And I want you to pay attention to certain items on this purchase invoice. The date of sale occurred on May 4th. Look at the terms of sale here, 210 net 30. We're to come back to this, but this indicates when cash payment is due. Again, this is a purchase credit. That term indicates when cash payment is due, and it also indicates that a discount will be allowed the buyer if they pay earlier. Look at the FOB shipping point term. We'll be talking about this term. This indicates the point at which the title transfers to the buyer. Any purchase of goods, clearly a change in title has to occur, and that's the point. The shipping point of the supplier is when the title of this goods is transferred to the buyer. Also look at the amount of sale here. For the two items purchased, a total of $3,800. The issue we'll look at later is when the buyer pays off the seller, will they pay the entire $3,800 or something less? That depends on whether they take advantage of a prompt discount payment. That is, paying early and taking an offered discount. In this case here, their offered discount is 2%. We'll come back to those terms shortly. So again, identifying the buyer, it's SAUK Audio. The seller is PW Audio Supply. And we're going to prepare the journal entry on behalf of SAUK Stereo, the buyer, for this purchase of merchandise inventory. Date of sale occurred on May 4th. And so the buyer is going to debit inventory $3,800. This increases the current asset. All assets are increased with debits. This is bought on credit, so cash does not change hands at time of purchase. And so SAUK Stereo will credit or increase the accounts payable account $3,800. The reason SAUK Stereo records the purchase on May 4th is because title has transferred at the point of shipping from the supplier. Let's look further at these freight terms. FOB shipping is the example on our illustration. Another term could be FOB destination. Two separate terms, which refers to the fact that title is passing at two different points in time. On the upper diagram here, FOB shipping point, FOB means free on board, and so therefore if the buyer assumes title at the point of the seller's shipping dock, the buyer must pay freight costs to get it to the buyer's location. The bottom illustration, FOB destination, a different selling term. At this point, the items are free on board at the destination of the buyer. So therefore, the seller retains title and pays any carrier the cost of delivering it to the buyer. We'll have examples in this chapter of the use of each freight term, and pay close attention because it affects the accounting involved. Staying with these two freight terms, let's illustrate our accounting entries if the buyer pays it versus the seller paying it. Again, it's going to be one or the other, but let's look at the entries involved under each circumstance. In the first case here, let's assume delivery of the goods on May 6th and that SAUK Stereo pays Acme Freight Company $150 for freight charges. The entry on SAUK Stereo's books, again, the buyer, will be to debit inventory. This increases the cost of the asset to the buyer. And credit cash, reducing cash. Why does the buyer debit the inventory account? Because freight is a part of the landed cost of acquiring merchandise inventory and making it available to sellers. Now let's completely reverse the terms here and assume the freight terms are FOB destination. That is, the title stays with the seller until the goods are delivered to the destination of the buyer. So if the seller retains title, the seller is going to pay the carrier the freight charges to move the goods from the seller to the buyer. So in this case, the seller pays the carrier and debits freight out, which is a seller operating expense. They no longer have the inventory, they've sold it, and so they're expensing it as they pay it to the carrier and crediting or reducing cash. So in this case here, the FOB destination point term of the freight simply adds an additional operating expense to the seller, which is expensed as incurred. What determines whether the freight terms are FOB shipping or FOB destination? These are generally negotiable between buyer and seller. Let's talk about a major event from a buyer's perspective. Before they pay for items, they may return one to the seller for various reasons. In any event, if it's returned before it's paid for, the buyer, of course, will reduce their inventory account because it's no longer available for them to sell to customers, and they'll also reduce their accounts payable account with a debit because they're returning goods before they paid for them. As mentioned previously in this chapter, we'll assume that all purchases are generally made on credit. Review question. In a perpetual inventory system, a return of defective merchandise by a buyer, purchaser, is recorded by crediting which account? Merchandise inventory. We're reducing the buyer's asset since they've returned it to the seller. It's no longer available for sale, and so they must remove it from their assets in their balance sheet. The other possible choices in this question refer to the periodic inventory system, not the perpetual system. Again, remember, on the perpetual system, we want to keep the inventory account updated at all times for all purchases and all returns, and eventually later for any sale that's made. Let's revisit the terms of purchase. Credit terms permit a buyer, as indicated, to claim a cash discount for prompt payment. Now, why would a seller offer purchase discounts when they made a sale on credit? Simply because they want to ensure that the purchaser pays very timely. Looking at the credit term here of 210 net 30, what does this mean? This means that the full purchase may be paid in 30 days, or it may be paid in 10 days, and the buyer is allowed to take a 2% discount. This has a great advantage to purchasers. They save money, and it shortens the operating cycle of the seller. They get paid quicker by giving an incentive to pay early. So again, here the normal terms of sale were pay in 30 days. However, if you pay in 10 days after the sale, the credit sale, the purchaser or buyer is allowed a 2% cash discount. The purchase discounts offered by a seller to a buyer can be whatever they would like to offer them. Here we have two examples here of a 2% discount versus 1% discount. The important thing to remember here is that anytime a buyer earns a discount, and they earn it by paying within the 10 days, it's called the discount period, if they earn that discount, they effectively have reduced the cost of inventory for the buyer. The buyer would have originally booked the purchase as a debit to inventory for the gross amount, but if they pay off earlier within 10 days, they'll be paying less than the gross amount. So therefore, the inventory cost of the buyer is reduced when they earn a prompt purchase discount. Let's record some of these entries to see what happens on the books of a buyer. The illustration here assumes that on May 8th, Sauk Stereo, the buyer, returns some merchandise to the supplier, the seller, and these goods were previously sold at $300. Or this is part of the original sale of $3,800, and here a portion of the goods are being returned to the seller before they're paid for. So, what entry does the buyer make on their books when they return goods to the seller? They reduce accounts payable, debit $300, because they're returning goods, they're not going to pay for them. And likewise, they reduce their inventory account with a credit of $300 since it's returned and they're not retaining this inventory. Remember, we're dealing with here retail selling prices, but the buyer is returning goods to the seller. And so this is a return entry only from the perspective of the buyer's books. Returning merchandise previously purchased but not paid for yet. Now let's assume the buyer, Sauk Stereo, pays the balance due of their previous purchase. Again, remember they originally bought $3,800 worth of goods, but they returned $300. So on May 14th here, the last day before the discount period, in other words, this is 10 days from the date of sale of May 4th, so they've earned a cash discount of 2%. So let's prepare the payment entry that the buyer makes to the seller after the returned merchandise and within the discount period that's offered by the seller. So the total remaining amount in accounts payable is $3,500, original sale of $3,800 less $300 returned. And so the buyer is going to reduce accounts payable by a debit, $3,500. They're going to reduce the inventory account by the amount of the earned discount. 2% of $3,500 is the earned discount. The earned discount only pertains to the amount that's owed at this point in time to the seller. And so the cash that's actually remitted, credit of $3,430. So in this case here, the buyer is discharging a $3,500 debt by only paying $3,430. Why? Because the seller has offered a 2% prompt cash discount if the buyer pays early. In this case, early being defined as within 10 days of purchase as opposed to waiting for 30 days after purchase. If this were paid off by the buyer 30 days later, they would pay the full $3,500 amount due. In this case here, they've earned a discount, and that earned discount reduces the cost to the buyer of the inventory. Remember that the buyer recorded the inventory gross when they first recorded the sale. Now they're discharging the amount that's due less earned discount. Change this example where the buyer fails to take the discount, instead chooses to make the full payment on June 3rd, which is 30 days after the original purchase of May 4th. The journal entry would be debit accounts payable, $3,500, credit cash, $3,500. In other words, no earned discount. This is a calculation which just offers the rationale for the buyer taking the discount. In other words, paying off early. By paying off early, they saved $70. If they didn't pay off early, they could have taken the amount they paid off, $3,500, and let's say invested alternately at 10% for 20 days and earned $19.18 as interest income. So the net savings to the buyer is $50.82 by paying off early. Remember, by taking the discount, the buyer in effect is paying 20 days early. They're giving up their cash before the end of the full 30 days. And so the comparison of what they're saving versus the opportunity cost for paying off early nets out to a savings to the buyer. Generally speaking, when cash purchase discounts are offered by sellers, it pays very much so for the buyer to take advantage of them. That small 2% discount, which is earned by paying 20 days early, amounts to an effective rate of 36.5% annually. Just to use an extreme example, There'd be a break even for the buyer if they had to borrow the money early, the $3,500 to pay it off. If they borrowed at a rate of 36.5% to gain a 2% discount, they'd be breaking even. Let's look at a summary of purchasing transactions from a buyer perspective. Again, the inventory account, the merchandise inventory account, will be a very active account when the perpetual method of inventory is used. So all purchases are debited inventory, and if the buyer is responsible for paying any freight, the freight costs are also debited inventory. Any returns of merchandise, though, in this case $300, are reduced to the inventory account, and also the $70 discount earned reduces the inventory cost because the buyer is paying less for the merchandise than originally booked gross when it didn't know whether to take the discount or not. Now, we've been concentrating on the purchasing transactions. We haven't looked at a very important one that's going to affect the inventory account under the perpetual method, and that is the sale event that has not yet been shown. As items are sold from merchandiser, they must be removed from inventory, and that will be credited in the inventory account. We'll look at that in the selling mode next. So again, recapping the flow of costs through the merchandise inventory account. Beginning balances carry over from the previous period, items purchased but not yet sold. Current period purchases are always added to the merchandise inventory account, debited. If the buyer is responsible for paying freight, such as FOB shipping term, free on board at the point of the seller's shipping dock, a buyer would pay freight to the common carrier and charge it or increase the merchandise inventory account, increases the landed cost of inventory. Likewise, if a buyer returns any merchandise to a seller, it must reduce the inventory, and any discounts earned by the buyer are also reduce the merchandise inventory account. Now let's move into the selling mode of the merchandiser. And as items are sold to consumers, the cost of that merchandise must be removed from the merchandise inventory account with a credit to the inventory. We'll see that as the other side of the entry is a debit to cost of goods sold. So on the selling side, again, assuming the perpetual method of inventory system, costs will come out of the inventory account. If the seller is responsible for paying freight under the terms FOB destination, that is, the goods remain in the title of the seller until they're delivered to the buyer's destination, this is a separate expense that the seller must bear, and we'll see it's charged to an account called freight out. Sellers who also experience merchandise returns will debit or increase their inventory account at their original cost. However, items returned and won't be paid at the retail basis also will have another entry to a seller. We will see that there will be dual entries on the seller's perspective when items are returned to them. A retail entry modifying the sales entry and a cost entry modifying their inventory that's in fact put back on their shelf for potential sale to someone else. Sellers who also grant prompt payment discounts will have a new account called sales discounts to deal with. This effectively modifies the original retail sales amount. You will see in this chapter that selling side entries are a little more complicated than purchasing entries in that there's many more accounts the seller uses under the perpetual method. So let's take the same example we started with and completely flip it over to the seller's perspective, that is PW Audio Supply, and see how they record entries for this transaction. So let's acquaint ourselves with the terms of sale again. First of all, this was an FOB shipping point sale. That means at the point of shipment by the seller has earned that sale. The title is transferred to the buyer at the shipping point of the seller. So the total retail sales again was $3,800. Now, again, we're focusing on the perpetual method of inventory accounting, which means that after every sale, we must update the inventory account. So from a seller's perspective, there are two entries to be made, dual entries, at the same time a sale is booked. Number one, let's book the sale entry, the retail price. If it's a credit sale, accounts receivable will be debited, increase that asset. Sales revenue explains why assets went up with a credit. The second entry must reduce the cost of inventory to the seller because they no longer have the asset. This is what's been exchanged, and so they must reduce their inventory at cost and move that to a cost of goods sold. The cost of goods sold is an expense in the income statement. The second entry, and there are two entries here that are separate but related. They each balance individually. And the second entry would only be made by merchandisers who use the perpetual method of inventory control, where they're continually updating their inventory account after each sale. I'd like you to look at these entries in tandem, though. They're related because they involve a sale or an exchange of assets. A merchandiser wants to sell their inventory at a price higher than their cost. This is what generates profit. And we can see the profit in these entries here. Both sides of the accounting equation are affected. We see in the sale entry that our assets go up by the retail price, the debit to accounts receivable, and that the asset exchanged in the second entry is removed at cost, the credit to inventory. That difference, if the selling price is higher than the cost, represents profit and is measured on the right-hand side in the owner equity part of our equation by the credit to sales revenue less the cost debit to cost of goods sold. So we have an exchange of assets and therefore an increase in assets on the left-hand side of our equation measured by the profit on the right-hand side, that is excess of sales revenue activity over expenses, cost of goods sold. Let's make the specific entries the seller would make here under the perpetual method of inventory system. So on May 4th, date of sale, they've earned the income, they've earned the asset, debit accounts receivable, that increases that. The Y part of that, credit sales revenue, an account under owner's equity. Simultaneously, dual entry, they must reduce their inventory and move that to a cost of goods sold. So they're going to debit cost of goods sold, $2,400. That's an increase to the expense category of the retailer, and reduce the inventory account, the asset they gave up at cost, $2,400. Two separate but related entries under the perpetual method of inventory system. Remember, we want to keep the inventory account constantly or continually updated after every sale. Now let's look at sales returns from the perspective of the seller. This is the flip side of purchase returns from a buyer. A seller must use a new account, sales returns, to keep track of any returns. They have to modify their original sales entry if items have been returned to them, but they're not going to reduce their sales account. They're going to bring up another account called sales returns, which is a contra revenue account. If a seller would directly reduce the sales revenue account upon sales returns, this would hide the importance of comparing sales and sales returns as a historical relationship. Now let's look at what the seller would do upon getting items returned to them that were previously booked as a sale. Again, we're assuming the perpetual method of inventory system, so there's going to be a dual entry here. We're going to modify the sales entry. We're going to modify original cost entry from the seller's perspective. First, let's deal with the retail side of the sales. Items are returned, so at the retail price, we're not going to debit our sales account, but we're going to debit a sales returns and allowances account. The merchandiser wants to keep a history of these sales returns. And since this sale was made on credit, what it's not going to receive is a payment of the accounts receivable, so the accounts receivable is reduced with a credit $300. Under the perpetual method, the inventory account must be updated. These items are returned to the seller. That means they could likely sell them again if they're in good shape. And so the seller will debit the inventory account at cost, $140, and reverse their entry to cost of goods sold because these items are no longer sold. So again, two entries. They both balance themselves. Retail entry at the top, cost entry at the bottom. Remember that under the perpetual method, the retailer wants their inventory account constantly updated for items that are flowing back to it. In effect, this entry indicates that this sale has been reversed in the books. Let's look at a special case where that returned merchandise was defective and did not have its full value to the seller. In effect, that it was defective and therefore only had a scrap value of $50. This is an assumption just for this illustration. First of all, the goods are returned. The selling price must be modified, or the sales entry must be modified. So the receivable is reduced by $300 credit, and sales returns are debited for $300. The sales returns account is a contra sales revenue account from the selling perspective and will appear on the income statement as a reduction of gross sales. So this first part of entry, no difference, the retail part. But the second part here, the goods are defective. They're not worth the cost to the seller of $150, but only $50, and so therefore we'll only debit inventory for a $50 increase and reduce or credit cost of goods sold for $50. Again, this is a special case where the cost value to the seller is lower because the goods are indeed defective. The seller here is effectively not debiting or increasing inventory for $150 because the merchandise is damaged and we cannot state assets at a value above their recoverability cost. Review question. The cost of goods sold is determined and recorded each time a sale occurs under which method? Only the perpetual inventory system method. Remember that as we reduce inventory, we increase cost of goods sold, which is an expense under the owner's equity category. Reducing assets that are sold, increasing expenses on the other side of the equation. Let's review how a seller books the sales discount that it offers to promote prompt payment to a buyer. Again, this is the flip side of a purchase discount. We're looking at it how it's recorded from the seller's perspective. Again, we're going to introduce a new account here, a new contra revenue account called sales discounts. Remember that as the seller booked the credit sale gross at $3,000, if the buyer pays it off early, they won't pay the full amount, and so therefore the seller's not going to receive the full $3,800 in cash because of that sales discount. Both the sales discount account and the sales returns and allowances account are contra revenue accounts that will modify the sales revenue value in the seller's income statement. The net of those numbers comes down to a net sales number. This allows a seller to keep a history of returns made after sales and any sales discounts given. So let's look at the journal entry that a seller would prepare upon receiving cash payment of an account receivable. In this case, not receiving the full amount because they've offered a discount that's been earned by the buyer. So this is a journal entry on PW Audio Supplies books the seller to record the payment made by the buyer after they've earned a discount. The seller is going to record cash of $3,430. How do we calculate this? The original retail sale, $3,800, less $300 returned by the buyer earlier, and that net amount of $3,500 is due, but it's paid early, so a 2% discount is earned by the buyer, 2% of that. So the amount of cash actually paid to the seller is $3,500 less 2% or $70 discount, or $3,430. The seller books a sales discount, $70. This will be deducted in their income statement. But they remove the full amount of the remaining accounts receivable, $3,500, from their books. So the total receivable amount is discharged by payment of a net amount of cash because the seller offered a prompt discount, you pay within 10 days, to the buyer. The sales discount offered by PW Auto here, the seller, is simply another cost of operations for the seller on their income statement. I'm not going to go through all the year-end closing entries for the seller, but this just illustrates that, again, remember that sales revenue must be closed out at year-end to income summary. Sales revenue has normally a credit account, so therefore we debit it and close income summary. And we have new temporary accounts here which must be closed out by the seller. For instance, the sales returns or sales discounts accounts, normally debit balances, are closed out with a credit. Cost of goods sold, the major expense item for a seller, debit balance account is closed out with a credit, and all the other expense accounts as indicated. The total debit of the sum of all the expense items and sales returns and allowances, $450,000, is debited in income summary. Again, these are normal entries we prepared in a previous chapter. The net balance income summary here is a credit balance, and so we're going to debit that to close it out and push the credit into owner's capital. And again, any balance in owner's drawing, normally a debit account, is credited and pushed into owner's capital at year end. This just reminds us that the account that inherits all the activity in the owner's equity is owner's capital. All revenue and expense accounts are closed out through income summary, eventually to owner's capital, and the drawing account also is closed out and its activity is pushed into a debit of owner's capital. Let's move to the format of an income statement for merchandiser. Looking at the multiple step income statement, this in effect simply divides up business operating results into separate categories or steps that will help us understand the income statement better. A multiple step income statement divides activities into operating activities and non-operating activities. I'm not going to go into that detail in this chapter. What I want to focus though on is the cost of goods sold. Again, the major expense item for merchandisers. This cost of goods sold account allows us to develop a subtotal called gross profit, which is not bottom line profit. Let's review what an income statement is all about. It's all about how many sales dollars are left after all expenses are deducted. What remains after subtracting all business expenses or costs of operation. So we're using a subtractive approach in looking at the income statement. Sales revenue dollars on top, net income dollars on the bottom. The net income is simply what's left of the sales dollars after deducting all expenses. I want you to pay particular attention to this diagram. This shows the chief subtotals in a multiple step income statement. Again, the cost of goods sold is the major expense on merchandisers' income statement. That deducted from their retail sales values gives a subtotal called gross profit. Retailers will look at their gross profit from period to period to see whether it's increasing or decreasing. In fact, it's such an important element that they'll express the gross profit subtotal as a percent of retail sales, called gross profit margin. Again, that's just a calculation of taking gross profit dollars divided by sales dollars to come up with the percent return on sales. Now, a merchandiser has a lot more expenses, salaries, rent, insurance, etc., and they have to be deducted at coming down to bottom line net income. So gross profit is not the bottom line results of operation of merchandiser. Net income is. Businesses will also track historically the amount of net income earned on sales, that is, the amount of net income or the amount of sales dollars left after all expenses are taken into consideration. For instance, net income as a percent of sales might be as low as 6%. Again, the base calculation in these percent returns are always the sales dollars. Looking briefly at various industries, these are bottom line net income profit margins. There's quite a bit of variability indicated here. Paper manufacturers having net income margins as low as 3 to 4%. Drug manufacturers having net income profit margins as high as 15%. Again, these margins represent what percent of the sales dollars are left after all expenses are deducted for a period of time. Let's look at an income statement. This is a format of a multi-step income statement. Starting with sales revenue at the top. Here a seller has experienced some returns, $12,000 worth, and have offered sales discounts for items that they sold on credit, and they induced the buyer to pay earlier by offering them a sales discount. So both of those amounts, $12,000 returns, $8,000 of discounts, are subtotaled and subtracted from net sales, or subtracted from sales revenue to come to a subtotal called net sales. Again, net sales are simply gross sales less any returns or sales discounts offered by the seller. Both those accounts normally have debit balances, contra revenue accounts. So the net sales amount of $460,000, we deduct our major expense, cost of goods sold, what it cost a merchandiser to purchase the goods that it sold to consumers at higher retail prices, coming down to a gross profit amount. So $460 minus $316,000, $144,000 is the gross profit for this merchandiser for the year ended December 31st, 2012. There are several other operating expenses shown for PW Audio, salaries and wages, utilities, etc. Again, note that the dominance of cost of goods sold as the major expense item on the retailer's income statement. Focusing back on the cost of goods sold, taking our gross profit, $144,000. This is the amount of sales dollars remaining after the cost of the merchandise sold to the retailer is deducted. So 144 divided by our total net sales of $460,000 gives us a gross profit margin or rate of 31.3%. This is not bottom line net income, but gross profit margin. Again, also entitled gross margin. Retailers will watch the history of this amount very closely. Return to our income statement. This just illustrates the fact that gross profit is not bottom line profit. The other expenses are deducted. In this case here, $114,000 of other operating expenses coming down to an income from operations of $30,000. Now the various expenses we see here under operating expense are recurring and normal operating expenses, hence the subtotal income from operations, normal operations. Now there may be other items affecting the income statement from this retailer called non-operating activities, such as disposing of long-term fixed assets, which is not done very regularly. There may be casualty losses from vandalism to their merchandise. These type of expenses are grouped in a separate category called non-operating because they simply don't recur on a daily basis as the normal sale of goods and operating expenses occur on a day-to-day basis. I'm not going to concentrate on the non-operating part of the section here, but I just want to show you that it does exist, and it does, in effect, categorize the recurring activities at the top from the non-recurring activities at the bottom. In this case here, after taking into account our non-operating activities, either plus or minus, interest revenue, for example, is a plus to the income statement. Gains on the disposal of plant assets, which we'll cover in a separate chapter, is a plus to the income reported by this retailer. Interest expense, part of the cost of financing their business, and casualty losses here are additional expense. Again, the non-operating expenses are not recurring and therefore are shown in a separate section, but they do net down to the bottom line net income of $31,600. So a multiple step income statement, again, simply divides operating results into separate categories or steps that help users of financial statements understand the various details of a business. This slide just shows us the various items that could be categorized as non-operating. In other words, not recurring on a day-to-day basis like the normal sale of goods. Review question. The multiple step income statement for merchandiser shows which of the following features? All of the above. Again, the cost of goods sold is the major expense item in a merchandiser's income statement. That deducted from net sales produces a subtotal called gross profit, which is very important as a measurement of ongoing profitability of the merchandiser. We're going to contrast that multiple step income statement to a single step income statement that's in your chapter. The single step simply says that we group all our revenues together and group all our expenses together and deduct one from the other. This is a very simple format, much easier to produce, but it does not offer much information. It's not as popular. It does not show, for instance, any gross profit subtotals. Taking a look at a single step income statement, again, all the revenue accounts, any gains on sale, any credit entries in the income statement are grouped together. In this case here, we have net sales after deduction of sales returns or discounts of $460,000. Other interest revenue gained by the company, $3,000. And here they sold the plant asset, not a recurring item, $600. Total revenues, $463,600. And then grouping all our expenses together, cost of goods sold being the major one, other operating expenses, other deductions, total $432 down to a bottom line net income, $31,600. The bottom line amount on a single step is the same as a multiple step. It simply shows less subtotals, less relationships in a company's business operations. This is not the dominant form of income statement. The multiple step income statement is commonly used by most businesses. Just a reminder, for merchandisers, the inventory account, often referred to as merchandise inventory, is the main asset that's purchased for resale. Until it's sold, it's carried at cost of the balance sheet. When it is sold, inventory is reduced and cost of goods sold is debited as the expense. And on the retail side, either accounts receivable or cash is increased at the retail price with a credit to sales revenue. But this one simple account of inventory vastly increases the amount of accounting that a merchandiser must deal with. The periodic inventory system, which is discussed in Appendix 5A of your chapter, was not our focus for this chapter. Just a brief contrast to the perpetual method which we looked at in this chapter. First of all, we record revenues when sales are made. No difference in periodic versus perpetual. However, under the periodic system, we do not record the cost of merchandise sold on the date of sale. We wait till month end to determine how much inventory we have, and by inventory difference, we determine that cost of goods sold. The periodic method does not provide timely information to a retailer on a day-to-day basis. Furthermore, since under the periodic inventory system, the value of inventory is not known on a daily basis, we don't record purchases directly into the inventory account. We use accounts such as, there are actually accounts called purchases or purchase returns and allowances. But again, this was not our focus. We're not using these accounts. When a retailer buys something under perpetual, we're going to debit the inventory account directly. And if returns are made to a seller, we're going to increase that inventory account to keep a continually updating of that on a perpetual basis. This illustration compares the perpetual inventory system, which we focused on in this chapter, versus the periodic system. Again, I want you to see that under the perpetual inventory system, that the inventory account is constantly updated after every purchase. And if the buyer pays for freight, that freight goes into the inventory account as part of the landed cost of that merchandise. As items are, this first slide, by the way, it focuses on the merchandiser as a buyer. So if the buyer returns merchandise inventory to its supplier, it would reduce inventory with a credit and reduce its accounts payable because it's not going to pay that off. Likewise, if the buyer earns a discount from the seller, when they do eventually pay up, they're going to pay less than the full amount that's owed. In this case here, the original purchase was $3,800. The buyer returned $300 of that to the seller and only owes $3,500, making the payment on May 14th. That's within 10 days of purchase. The seller offered a 2% discount or $70. And so therefore, the cost of the inventory is reduced by $70 since the buyer has earned the discount. And so they discharge their debt of $3,500 by paying $3,430 in cash. Note that the periodic method, which we're not concentrating on, does not make these entries direct to the inventory account. The periodic method is not concerned with keeping that inventory account updated on a continual or daily basis. Moving to the seller activities, comparing perpetual versus periodic inventory system, focusing on the perpetual column, as a merchandiser makes sales, it records those sales at retail value, in this case, $3,800. We're just taking the flip side of the illustration earlier in the chapter here. So accounts receivable is earned, the asset increases by the retail amount. The sales revenue explains why assets went up. And then the dual entry, related but separately balanced, reducing the cost of inventory to the seller, $2,400, and moving that into a cost of goods sold or expense account under the owner's equity category of the seller. Note that the inventory account and the cost of goods sold related account is not updated under the periodic inventory system. Under periodic, that waits till month end to make those determinations. Moving back to the perpetual system for the return of merchandise, from a seller's perspective, they in effect incur a cost of doing business by allowing those sales returns, debit sales returns and allowances, credit accounts receivable, the retail entry, the modification of the original retail entry. Likewise, a reversal of the cost of goods sold. In cases where merchandise is returned, you will be given the cost of that merchandise, so that's put back in inventory by the retailer, debit inventory $140, credit cost of goods sold, in effect reverses the sale transaction at the cost level as if it never occurred. And finally, from a seller's point of view, when they receive cash, net of discounts earned, even though the seller has $3,500 on their books as a debit receivable, it's only discharged by the buyer for paying $3,430. They've earned a $70 discount. So from the seller's perspective, they book the cash received, they relieve the accounts receivable at the full amount, and recognize another operating expense, in effect, debit to sales discount. Again, the sales discount account, the sales returns and allowances account are considered contra revenue accounts and a direct deduct from sales revenue in the income statement to come down to a net sales number. I'm not going to go through this 10-column worksheet, which we covered in a previous chapter. But I simply want to point out the new accounts introduced into a merchandising business as opposed to a service business. So merchandisers are buying and selling inventory, and they're incurring sales returns and allowances and sales discounts if they allow returns to be taken back, and sales discounts if they allow for a prompt discount of a credit sale. In effect, those are contra revenue accounts. The cost of goods sold, the major expense account, represents the cost of items to a merchandiser when they sell them. Of course, purchases made by a retailer not yet sold remain in the inventory account up above. A few endpoints here from a global perspective. The International Financial Reporting Standards, as issued by a group in London, also has perpetual versus periodic system elections. More importantly, at the bottom here, it's interesting that the international standards do not mention a single step versus multiple step income approach as is spelled out in the U.S. under U.S. GAAP.